by bringing you a chat on the markets and where things could really be headed from here. To talk about that, we have George Thomas, fund manager at Quantum AMC, joining us now to discuss where the markets could really be headed. George, thanks a lot for joining us today and, being with us on this show today. So, the last today and yesterday, what we're seeing is, of course, come through after the Fitch downgrade for US credit ratings. But do you think that this is just something which is very temporary, and once this is done, we can attempt to move higher once again? Or do you think we're likely to see this consolidation for a while now?
Yeah, thanks for having me on the show. So given the sharp rally which we have seen recently, there is a good possibility of a short-term profit booking, but the correction, it will not be a very material correction because given there are a couple of reasons. The underlying economy is doing fairly fine. So we are not seeing any serious concerns there. And even corporates are reporting reasonably okay results. So we are not seeing very, alarming signs where, which would lead to a material market correction. Of course, there could be volatility in FPI flows with all the news flow which is happening around the global front. But our sense is, as and when the valuations get a little more cheaper, the domestic institutions will participate and the chances for a material correction is quite negligible. And as far as the US news is concerned, it doesn't seem to be a material trigger to sustain for the longer term.
George, what about auto? Auto is one sector where we've seen a lot of EPS upgrades. Most of the earnings have been on the positive side. Do you think this EPS upgrade cycle for automotive companies will continue? And if yes, which ones would you pick? The PV, the two-wheelers, the tractor maker?
Yeah. So tractors, of course, after the stellar run in the last few years, we might see a subdued volume growth, at least in the medium term. And of course, even the current year numbers has been fairly strong, which kind of reflects the underlying strength. But typically what we have seen historically is, there are cycles which play out and therefore the growth could be moderate in the next few years. But two-wheelers, we are quite positive. In the sense, last decade, we saw rapid price hikes along with cost inflation. And the cost part is at least moderating for now. And that's visible in those earnings numbers. So that trend is likely to continue for some more time. And at some point in time, we would also see the volumes kind of catching up because we are all anchored to what kind of volume growth we saw in the last decade, which was subdued for multiple reasons, and there could be some normalization to that extent. So the two-wheeler auto space looks pretty attractive for us.
Like two-wheeler space. George, hi, morning. We've just seen this big deal being announced in the cement sector, right? And it's very clear that the Adanis have massive ambitions for this space. The Sanghi deal is already done after ACC and Ambuja. How do you view cement? Does it make the cut when you're talking about playing let's say, the capex theme or the infrastructure theme? And if yes, then what type of assets or what kind of companies do you look out for?
Yeah, cement seems to be an interesting play, at least, from a cost front. A lot of those high-ticket cost items, which are the power and fuel, and which is almost a significant part of their operating cost. So that's moderating at a fast pace, and that would reflect in better profitability. And even with all the infrastructure development and even a potential private capex revival, we would see volumes kind of picking up. But the flip side is, we have seen a reasonable amount of capacity additions in most of the regions. Barring North, most other regions are likely to have a utilization range which may not allow material price hikes. So the cost factor will give some improvement in profitability. Volume growth would be decent, but the realization growth could be capped. So if we factor all those factors together, most of the companies are trading at slightly above fair valuations.
All right, got that. That is on the cement space. What are your thoughts on the pharma sector? Because we've seen quite a pickup. Even the Q1 numbers coming through, for most of them have looked quite good. I'm talking about the larger players. Do you think this up move is likely to sustain for a while?
Yeah, our sense is, pharma sector is likely to do well, at least for some time now. So if you look at the US patent cliff, which is amount of drugs which are where the brands are expiring. That is almost close to 3 times of what we saw in the last 5 years. So that will provide some support in terms of the US players with a reasonable exposure to US. And even India is growing reasonably well. So players with a decent exposure to both these markets are expected to do fairly well. And even there are certain, some drug shortages and stuff in the US market. And therefore, you would see more acceptance of and more Indian players being able to sell more products in the US market.
George, out of time. We've got a packed show. Thank you very much for joining in. Need to get into a break. On the other side, we'll put the spotlight on pressure.